All right. We're back again at the Beat the Odds of Business and Wealth podcast. And today we've got, of course, Josh Spurrell, who is in our Manila office. Hey, Josh, how's it going today?
Oh, pretty good, Trevor. Excited to talk about this topic. I think this is one that really gets me riled up sometimes. I'm here in my Manila office where they have me work here. I call it like the Manila closet. It's like, I don't know, last week I was in a opulent at the Address Beach Resort Hotel in the lobby, and today I'm in the Manila closet, as I like to call it.
The Manila.
Yes.
Well,
But team's working downstairs. I can get away up here. So yeah.
well, a little bit of humility, I guess. We're working out
That's
of the
right.
closet. The sacrifices we have to make, for our businesses to grow. So today we're going to be talking to the audience about how, insurance companies kind of rip you off and prevent you from creating wealth. So I'm interested in learning more about this. I know like insurance is something that you rail on with your clients regularly because they're not the best products, and they don't have, I think, the customer's best interest in mind. So yeah, let's roll into this.
Yeah, I mean, my whole thing is like these are sold by salesmen. They're not advisors. They call themselves advisors, but they're sold by salesmen. Maybe they think they're giving good advice, maybe, or maybe they actually know that it's not good advice. Because I have clients who sell insurance who don't use that as their fundamental mechanism for financial planning, but they will recommend it to the clients that they have. So it's a little bit absurd, but I want to break it down like first principles, because insurance is sold by fear. Fear is one of the most powerful motivators that people have. And so it tends to obscure their judgment, and they start making decisions not based on reality. Okay. The very first thing that people have to come to terms with in any sort of planning scenario, and this is the financial planning, this is business, this is life, is like there is no risk scenario.
Right.
That is the number one thing that people have to face, is that the no risk scenario does not exist. Okay. The minute you get into your car and drive to work, you have now taken a risk that maybe that car does not make it there. It's like that risk might be low. That risk is much lower if you're driving to work in Canada. It's much higher on my ride in here to, in traffic in Manila. That something bad would happen, but, it's still relatively low in the scheme of things. Okay. I'm not, say, race car driving or rock climbing that might have a higher risk, right? But the number one thing that people have to get out of their heads is that there is no risk solution. And this is how insurance policies are sold. It plays on your heartstrings as if you buy this product, listen to this story that happened to this person that I know. Here's this story, personal, fearful, tragic sounding story, and buy this product. And they don't say it explicitly, but it's said to make you feel like now this turns your life into a risk-free life, which does not exist, right? And it's one of the primary things is like you're in the Edmonton office right now, and it's like there's one of my favorite posters is right behind you, Trevor. And like, what does that one say right behind you?
It says, "Do not be afraid." It is written in the Bible 365 times. That's a daily reminder to live every day fearless. That's what it says.
Now maybe I can't get everyone fearless, but at least maybe we can get them to somewhat thinking logically, and this is what we're going to try to help them do in this podcast.
Yeah, and let's clarify the insurance that we're talking about today, not necessarily car insurance or home insurance, which are both ripoffs in my estimation, because I told you right before the podcast here that we received a letter in the mail from our insurer that rates are going to be going up because of climate change, because forest fires and hot weather is going to, and fires and floods are making it more expensive for everything, which is a load of horse manure. But anyway, we got our rates are going up because of climate change. So thank you for that. But we're talking about life insurance, right?
Yeah, it's gonna flood. How many meters above sea level are you in Edmonton or your house? But that's gonna somehow gonna flood because of climate change. It's like I think we got bigger problems than house insurance if it floods there.
Right?
But yeah, I think we need an arc. The only solution is an arc at that point if that thing floods. So
Well, we've had so much
um,
rain here this year. I'm starting to look for someone building one. But
yeah,
anyway,
they,
yeah.
they are.
So we're talking about life insurance.
Okay.
We're
So
not
I
really
mean,
talking about term. We're talking about that universal life or whole life products, that kind of stuff, right?
yeah, life and disability just in general. Okay,
Yeah.
so once you get over the fact that there is no risk solution, it just does not exist. Okay, and a no risk solution does not exist. Now you can actually start to think critically. It's like, what is the probability of this happen? I'm going to give you like a general rule of thumb, and you might get slightly different answers, but if you get wildly different answers, I'm telling you they're wrong. Okay, the probability, if you are a healthy person, no pre-existing conditions, you're just a regular 40-year-old female or male, and you're just wondering what is the probability that you're just going to drop dead before the age of 65. You're not involved in any risky lifestyles. You're not an extreme rock climber. You're not hooked on fentanyl. It's just like you're just a regular person. Okay, no pre-existing conditions. You're not even all that healthy. You're just like regular health, not a fitness guru or anything like that. It's like you got about a 10% chance. It's like the 1 in 10 that you're just going to drop dead by the time you're 65. It's roughly 1 in 10. Maybe you get some stats and someone that's going to tell you it's 8%, and someone's going to tell you it's 15%. But if someone tells you it's 40%, it's like they're full of it. They're just trying to sell you something. Okay,
Yeah.
that's not the likely outcome. They can tell you as many personal, heartbreaking stories as they want, but it's like, what's the likelihood? What's the probability? It's like when that fear creeps into your system, it prevents the reasoning portions of your brain from functioning properly. Okay, so you got about a 10% chance. You also have roughly a 10% chance that you're going to become permanently disabled, that you will no longer be able to have meaningful work at any other point for the remainder of your life before the age of 65. Okay, so before the age of 65, you got about a 10% chance. Okay, so because what normally happens when people become disabled, it's like the normal outcome is now the chance of becoming disabled is slightly higher. Okay, like roughly like 1/3 of the people will suffer some sort of disability, but the likely outcome of that disability is either you will get better, it will subside, and you'll have some way to learn to live with it and go back to work, or you die. It's not the standard course. It's not the more common that you become disabled and stay permanently disabled from the age of 45 to 65. Like that's not a very statistical likely outcome. So there's only about a 10% chance that you suffer some sort of permanent disability, something that's not going to rectify in a year or two that you can get back to meaningful employment. And there's only about a 10% probability that you're going to drop dead. Okay. Now it's going to be slightly different health profiles, different risk profiles, but it's not wildly different than that, people. It's like not wildly different. So just like this is the back of the napkin map here. Okay. So Trevor, that's the 20% probability, right? That's the 20% probability, permanent disability, or you're going to die before the age of 65. But here's what they don't tell you selling the insurance. What's the 80% probability? What's the other? What's
And
the
I
80%
think,
probability?
yeah, and I think that's the biggest issue that I have. Like I watch, there's a certain influencer online that I watch, and he used to be into that. He used to sell for one of the big, multi-level marketing insurance things, and he always tells that story of that one time he didn't sell the plan. He wasn't feeling it that day, and he didn't sell the plan, and then the husband died, a new baby on the way, and he sells this whole thing, and that was his shtick, how he's able to use emotion to sell somebody an absolutely horrendous investment product. Like he got extremely wealthy because of the fees and the commissions and all the downline that he gets on all of those sales. But on the other side, most people don't get the benefit of that insurance, and any investment that is made inside of that insurance product, it doesn't amount to a hill of beans. It doesn't keep up with inflation. So maybe talk a little bit about that, because that's something that really kind of cheeses me off.
Yes. And so like The 20% probability is a permanent disability or you're going to drop dead before the age of 65. Okay, the 80% probability is you're going to get old and it's going to be more difficult to work at some point in your life. That's the 80% probability. And it'll start harder to generate income as you get older. Okay. So like there's the 20% that's sold with fear, and then there's 80%. Okay. Now, what happens is most people view insurance as the foundation of their financial planning, as if that was the 80% probability. But in fact, it's the 20% probability that I'm going to need disability or life insurance. So if you start thinking about like just term life insurance or disability, and it's like pretend you have two choices, and you only had two choices. Now this isn't the way it actually works, but just pretend you had two. And choice number one was to invest, so you have some money put away when you are 80 and it's harder to work and generate income. And number two is you can insure that something happens to you before the age of 65, you become disabled or die before the age of 65, you get an amount. It's like, you know how many people that we see come in and they have most, if not all, of their excess cash flow going towards insurance and very little excess cash flow going towards investments. It's like those two things should be flipped around.
Yeah.
They should be flipped around. Investing is senior to insuring. Okay. You should be betting on the fact that it's the 80% probability. That is, now we don't live in a world where you only have two choices, but if you did, investing is more important than insuring.
Yeah,
Okay?
because like in that sense, then you become self-insured. So your investments should be able to get to a point where they would take care of you when you're plus 65, 70, 80. If you start, young and you're prudent with your investments, you're able to live on the dividends. And that's much better than any annuity or any life insurance program that's even out there. Because remember, folks, like these life insurance products are sold by salespeople who get paid a commission year over year over year, so that as long as you keep paying your premiums, right? And insurance companies like typically don't go broke, don't lose money typically. But I mean, I guess it can happen. What are your thoughts?
Yeah. Yeah, I mean, so then once you get over, that's like kind of a term insurance, disability insurance. It's like in an ideal world, you're protected, you're protected for the 20% probability, and you're putting most of your eggs in your basket for the 80% probability. That's the ideal world. But if you only have one, which one's senior? Which one is the foundation of that house? The foundation is not insurance. The foundation is investing. Okay, that should be the foundation. But then it gets more complicated because they sell these insurance products as investments. There's a return of premium on the disability, or there's an investment component to the life insurance, whether it's a whole life policy or a universal life policy. And like before we go crazy down in the comments, like I know what these are, people. Like I know what these are, and I know it's going to be very disappointed for someone who listens to this because there's going to be people who listen to this who their income depends on me being wrong about this, but I'm not wrong about this. This is where the one where I always rag on Dave Ramsey, about not using debt, but me and him are 1,000% aligned on whole life and universal life policies. But there are better options out there, okay? Because when they sell these options, so first of all, with the other thing with insurance, it's like, especially with disability insurance, the second risk, once you get past the fact that there are no risk solutions, once you get to number two, you have to understand that there is a probability that if you buy insurance, when it comes time for them to pay out, that they will fight you on it.
Yeah,
that they will fight you on
right?
it. So they don't roll out the red carpet. They look for excuses on not to pay. And this is what happens. Like I got a client whose his whole job is actually working for insurance companies and coming up with reasons why they should not pay. That's how he makes hundreds of thousands of dollars a year. I don't know how he does it every day, but he does, and he does very well at it. And the insurance companies pay him very well for it. But that's the thought. It's like, it's not a certainty that it will pay out the way you thought it's going to pay out. They're not going to roll out the red carpet. Whereas if it's your investment, you have complete control over it. You have complete control. So even in the interim, even if they're owed to you, and like even if they pay, do they pay on time? Okay. Do they pay on the time frame that you thought they were going to pay? Whereas if you had liquid investments, those are yours when you want, how you want. Okay.
Mm-hmm.
So you have to understand this is why investing is senior to insuring. Okay. So I'm not saying that you shouldn't get any insurance. What I'm saying is investing is more important than insurance. Okay. And you should understand why. And if you're not understanding that, then you don't understand the limitations of insurance and the probability that you're going to use the insurance. Okay. And the potential for that insurance to not turn out the way you thought. But then we have to get into where they sell insurance as an investment. So there's a return, a premium, a disability, there's a whole life policy, a universal life policy. And they sell these things and they compare them to one of two things. They compare them to doing nothing, sitting on cash, or investing in things that don't give a good rate of return.
Mm-hmm.
That's what they compare them. When you look at the models, it's like if you do this, it's like, yeah, if I buy a whole life if I buy a whole life policy or a universal policy, it's better than me sitting on the cash. Yes, 100%. And if you look at the model like that, it's like, I should do that. But the thing is, you have more options than just sitting on cash. And sometimes they compare it to other investments that don't give a rate of return or investments that are not efficient for tax purposes. If, for example, just sticking a whole bunch of money in RSPs and wondering why that's not an intergenerational, tax tool and that you're going to pay 50% on it. It's like, yeah, if I compare it to that, that's great. But there are other options out there. And this is where it's their limited knowledge in investing that puts them into this trap where they start to see these rates of returns in these insurance policies and understand that it's, a 5 to 7% rate of return, and they're comparing it to no rate of return or rate of return in a tax inefficient vehicle, a similar rate of return in a tax inefficient vehicle. And they don't realize you could have just got 10% or more. That's what they don't understand. And so even if they were in a vehicle that was not efficient for tax, just that rate of return would dwarf the tax savings of the insurance product, where they could pay the tax 1, 2, maybe 3 times, depending on how long and how much they overperform the insurance, and still be better off,
Yeah.
right?
Well, it also goes back to, fear, right? So the banks, the insurance companies, they don't want people to get into investing or learn how to invest on their own. And let's be honest, like most people are very lazy and they don't want to take responsibility. They would rather just hand over their investments and hand over the keys to somebody else because it seems too confusing. It seems too hard because they use a lot of jargon and they pull out a lot of charts and spreadsheets and make it seem like it's super complicated when it really isn't. They use fear, number one, to sell the insurance product, and they also use fear to prevent people from actually starting investing on their own, because they certainly can, right?
Yes. And it's very and zoom out on these things, people, and zoom out and then look at the rates of return that they're actually been able to get in these insurance policies, especially in the last 25 years. Okay. Especially in the last 25 years, because the monetary system that we're in is different than it was 50 years ago. Okay, the rates of debt have gone up, the rates of interest have gone down. A lot of these insurance products, are very susceptible, if not at least somewhat susceptible to interest rates. And interest rates are lower than they, if you look at, 50 years ago to 25 years ago, interest rates were higher. Okay. But now they are lower. And when you understand the debt loads of various governments about the world, you'll understand why the interest rates can't get back to where they were in the 80s, because it will be financial Armageddon, which is what I told everyone. When your interest rates started to go up and say it's going to go back to the 80s, like, I can't. The system will blow up. It would literally blow up. Okay. So there is no way it's going to get back there. So you have to have a realistic rate of return looking at the last couple of decades in these insurance policies, not looking at 50 years of these insurance policies, because the last couple of decades are going to be more similar to the next couple of decades. What happened 50 years ago or in the 70s and 80s when they came off the gold standard is different. The system is different now. There's 3 times as much debt in the system. So we're not getting back to those interest rates. And you're not going to get the same rate of return in some of those insurance policies. But even if you did, there are still better choices. Okay. But people don't know how to invest. So they're forced into these. And then they sprinkle in the most effective secret sauce, which is fear. do it, or you're going to fail yourself, and you're going to fail your family, and you're going to fail your kids by not doing it. You know, and so not doing anything is a failure. Okay, so not, you know, I'm not saying don't insure. I'm saying, have you considered the other alternatives? Okay. Do you have the right allocation between investments and insurance? Do you have 80% of your free cash flow going into insurance products, with, you know, no rate of return? They're pure insurance, and you only have 20% going into investments, even though there's the 80% likelihood is you're gonna use those investments, not the insurance, right? And then there's like another kicker in it. If you want to see like how bad these are, it's like if you start comparing the last, you know, couple of decades of these insurance products and the rates of return, then go and compare the rates of return as if you just would have bought shares in those insurance companies directly. And like I rag on them all the time, but
Isn't
I
that
own
ironic?
shares in all of them. So you know, I hope the people watching this podcast learn better ways and allocate only the right amount to insurance and understand that investments are better. But I hope the other, you know, viewers watching the other, you know, the other podcasts, I hope they buy a lot of insurance, because I need my dividends from Manulife and Sun Life, and I want those for 100 years. So please keep buying them, okay? But just not my clients. Not my clients. We're going to show you a better way. We're going to show you more efficient investment vehicles. We're going to show you intergenerational wealth that does not involve crappy rates of return on insurance products. We're going to show you how to actually avoid the tax, as opposed to buying an insurance policy to pay a tax that you could have avoided if you would have structured your life profit, you know, and a true intergenerational wealth plan. Okay. And that's what we, you know, that's what is possible. So don't let those insurers actually kind of bully you and make the fear, you know, and make you make the decisions based on fear. It's like, there are better ways. Okay. And when you start to looking at it, it's like, I can, there are things that I can invest on that have given me 10+%, and that have given me 10+% for decades, and are likely to continue to give me 10+%. And there's going to be a delta in between what I can get in those and what I can get in an insurance policy. And, you know, you have to understand, it's like, am I looking at the 80%? And then there's a couple like drastic examples. It's like when I see people insuring for like disability, they have no assets. They have no assets to speak of, and they're buying disability insurance for like $2,000 a month. And then I have to tell them, it's like, you understand that the government will just give you $2,000 a month if you're disabled? If you become disabled and you have no assets and no one can take, like, this policy is completely useless, like completely. Or like single people with no kids and no dependents, and they're insuring for, I don't know, the person who has to bury them. So like, you know, there's some like really comical examples out there where it's just like sold because it's like normal. It's like just normal. And, you know, the really nefarious thing that you see about it is, generally speaking, you know, people with lower wealth and lower income levels put a higher percentage of their income and wealth into insurance products, and people with higher wealth and higher income levels tend to put a higher percentage of their income and wealth into investment products that will actually, you know, are guarding against the 80%, because at some point you're probably going to want to live off those investments. It's going to be harder and harder to generate income, but the probability that you're just going to drop dead one day unexpectedly or become permanently disabled is actually very low. And most people are not facing that right at the beginning of the decision-making process.
Yeah, for sure. And, you know, then not only talking about investments, but about leverage. Like the insurance company is using your funds as leverage to invest in higher performing assets. Of course, they have to buy a certain amount of crappy bonds, but at the same time, you know, they're getting wealthy off of your money. Why don't you go ahead and circumvent that and you get the 10+% returns on the money that you're putting out there? You can have term insurance, you know, just in case of oops, you know, I didn't predict I was going to get hit by a bus this, you know, tomorrow. And you have some term insurance to make up that gap. But, you know, if you are putting your money, rather than putting $2,000 a month into an insurance product, why don't you put $2,000 a month into dividend paying stocks? Like, you know, then you're making that money, and you can also get some leverage working on your behalf.
Yeah. And the minute someone tells you that you can lever an insurance product, you can borrow against it, but you can't lever your investments. That just shows you their knowledge of investing, that they don't understand how to lever their investments, that they think you can only leverage an insurance policy because that's what the person who at the front of the class told them in their weekend seminar before they started selling insurance. It's like, you 100% can leverage your investments, and you can do it generally at a better rate than you could on the insurance products. Like,
Yes.
you just start to look at like how nefarious it is. Like, it's sold as a tax-free solution to people who have not even maximized their TFSA contributions. They haven't even maxed out their TFSA, and they're wondering for some magical silver bullet on how to, have tax-free rate of returns. It's like, well, I mean, that's one of the terrible ones of people buying these massive universal life policies, and they haven't even maxed out their TFSA yet. Like, it's just. Why did the person advise them to do that? Because they got a massive commission to sell them the universal life policy.
Yeah.
And buying an index fund in their TFSA, they get nothing for. That's why you did it. Okay. And so, that's what we have for you. If you want to up level your information on what you could do instead of insurance, that's what we have the boot camp for. Hit the link, go to the website, hit the link, buy the tickets. We'll see people in November. We'll give you the strategies of like what you could do instead, so you can evaluate this, logically, as opposed to evaluating it based on a one story that pulls at the heartstrings. That's not statistically relevant, because I guarantee you the heartstring story is like the real heartstring story is like, people who come into the office and they're 70 or 80 years old, and it's too late for them. They can't generate enough income, and I have no solution for them. It's like, that is painful. That is going to be another 10, 20, 30 years of that misery. And that is a real outcome. And that is the 80% probability for most Canadians, where they're living off of $2,600 a month, and they paid their insurance dutifully throughout their life, and they wonder like what would have happened if they would have allocated some of that insurance money towards investments that would have got them an actual good rate of return. Their quality of life would have been much, much, much higher for the final 20 years of their life.
Yeah, exactly. All right, people, you deserve better. We'll see you at the boot camp. Thanks so much, Josh, and we'll catch you next week. Next week, I'm going to be the one out of town, and I don't know exactly where I'm going to be, but we'll pick it up by Zoom, and we'll talk to you next week. Take care.
Sounds good, Trevor.